Okay, welcome to our educational Zoom series where we explore and learn different topics to gain financial literacy and achieve financial freedom. Today, we'll explore cost segregation with Yona Weiss. Yona is a powerhouse with property owners' tax savings. He is a business director at Madison Specs and national cost segregation leader. He has assisted clients in saving hundreds of millions of dollars on taxes through cost seg. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and hosts a top podcast named Wise Advice. So, Yona, welcome.
Thank you so much, Diva, for having me. It's great to join you tonight.
Thank you. It's an honor to have you on. So, Yona, please tell us a little bit about yourself to begin.
Sure. I mean, you gave a great introduction there. I wonder who wrote that. It's really written well. As you mentioned, I was a teacher for many years, about 15 years, and then got into real estate about 7 years ago. Did many things in the real estate business, but my passion has always been teaching. I have a big family, 6 kids, and that keeps you busy in teaching all day long also. But when I came into the real estate field, I was, as a teacher, I'm a student also. Every teacher is really a student at heart. I'm just trying to learn, and whatever you learn, you want to teach others. And real estate is just like fascinating to me, so many different aspects around it. When I came across this subject, cost segregation, I was like, whoa, this is something. I started asking people around. Almost no one knew what it was. And I was talking to like successful, real estate brokers and investors, and it was fascinating to me. So I saw a kind of niche there that people didn't know. And thankfully, the company I work for is the biggest national company that does this. So I had a great platform, a great company kind of to have that support system with. And all I've been doing for the past 5 years within that company is just teaching about this subject. And ultimately, it's one of those things that when you learn about it, it's almost like a no-brainer.
Right. No, thank you for that. So it's amazing that nobody even knew about it. So is it a relatively new topic where these investors who are sophisticated not using it?
It's not. It's been around for decades. And depreciation, which is really what cost segregation is, everyone knows what depreciation is. It's a tax deduction when you invest in real estate or you own a property. Besides for your personal residence, you're able to take this tax deduction called depreciation. But cost segregation is just an advanced form of that. And since it's tax related, you would think that accountants or CPAs are the ones that really deal with that. But in this case, they're not, because you need an engineer, you need a third party to actually do what's called a cost segregation study, a report on the property, which actually breaks down the depreciation into different categories and different components. And we'll get into what that is. But that was what really intrigued me, was that the CPAs themselves don't really know about it in many cases. And that's probably because they're not focused on real estate. I mean, if you think about like a medicine, right? A general practitioner, they may know about certain fields, but they can't do it, and they'll just refer you to someone else. And so that's kind of the same thing with taxes. The tax code is massive and huge, not to make comparisons necessarily between a doctor and an accountant, but you see it's so huge, and you can really only specialize in one area. And that's really, when it comes to real estate, you need an accountant. If you are a real estate investor, you really should have an accountant that is specializing in real estate. And so cost segregation is one of those things for real estate investors that either you know about it and you use it, or you've never heard of it, or it's not something you're going to necessarily figure out on your own unless you're coming to seminars and sessions like this where you're learning about different strategies within real estate.
Right, got it. So you mentioned that we can use it on investment property. So the tax code suggests that we cannot use it on our own residence.
Correct. Yeah. So depreciation is a deduction given for an investment or business property. And essentially it's like an incentive. The government wants you to function, a business wants you to function as an investor, and because that contributes to the society and to the economy. And when you invest into the economy, whether it's through property or what have you, you're giving an incentive. So that the government gives you this tax deduction based on the purchase price, based on the value of the property. What's interesting is that it's not intrinsic to the value necessarily of the property. And depreciation sounds like something's going down in value, But in reality, it's just a borrowed term. This deduction called depreciation, it's a borrowed term for some, like things go down in value, so too you're able to take a deduction from your taxes as if your property is going down in value year after year, when in fact it starts the day that you buy the property. So your 27 and a half year schedule is going to start the day you buy it, even though the property may have been built, 50 years ago.
Right, right, got it. So it's an incentive from the IRS in the tax code for investors who invest in housing for others.
Correct. Yeah, and this really applies to any type of property, but obviously multifamily is a very popular one. So yeah, it's not limited to housing per se, but for really any type of business or investment property. Really interesting, though. I will note, because I'm sure there are people out there, maybe you're listening to this, and you may not consider yourself a real estate investor, but I've had on many occasions doctors or business owners who happen to own the building that they practice out of, and they may use it for their business, for their a warehouse, or a doctor may own the office building and take a unit and then lease out other units. They didn't necessarily consider themselves real estate investors, but in fact they are when it comes to depreciation. So you're able to take this deduction as a business owner because you own the property.
Got it, got it. See, not a lot of business owners think they are real estate investors, even though they own that real estate that they're performing business in. Okay, perfect. Thank you. Could you please talk a little bit about how it's useful as an LP to invest, and how cost segregation comes into play for an LP limited partner?
Absolutely. So as if you think about a singular person or a business investment, you have an LLC, you have a partnership, you're able to, whoever owns that property is able to take this deduction. Okay. So depending on the percentage of ownership of your interest, of that LP interest, that's how much of the total depreciation you'll take. So just to illustrate with an example, if we're taking regular depreciation means we take the purchase price, we subtract a small amount for land, and then the remaining amount, we're going to spread that out over a 27 and a half year period. So to illustrate simple numbers, let's say you bought $1 million property and you take off, 200,000 for land, or 20%. And what's remaining is $800,000. If you divide that by 27 and a half, you're going to be left with, approximately $30,000. It's a little less, but just to keep it simple math. So your deduction is going to be $30,000 a year of depreciation, meaning if you make from the property income, let's say $50,000, then you're only going to be taxed on the remaining $20,000. Okay, so because you've deducted $30,000, and then so that's how regular depreciation works. What cost segregation does, and we'll get to how this affects the LPs, is we're able to front load some of those deductions to the earlier years. So you have this pool of deductions that you can take over a 27 and a half year period. And instead of just taking an equal amount of $30,000 every year, you want to pull from a certain portion of that. Things that actually the IRS says depreciate faster, like personal property and furniture, fixtures, things like that. You can actually take sometimes 20 to 30% of, in a multifamily property, of that value, and take it all up front in the first year or over a 5-year period. So instead of taking $30,000 a year, with cost segregation, you may be able to get $200,000 in the first year, okay, with bonus depreciation. So now, how is that going to affect you as an LP? That means it's going to spread to you, going to be split up to you according to your percentage of ownership. Every owner will have that amount. So let's say there are, just to keep simple terms again, let's say you have 10 investors and everyone invests and owns 10% of the property. Okay, and everyone all together, just to keep it very simple. So each investor will get 10% of that total depreciation. Okay, so in that $1 million property, if you didn't put any leverage on it, meaning there was no financing from a bank, it was all cash. Okay, so that $1 million property, everyone put in 100,000. Okay, and you're going to get back, let's say $200,000 total. That's going to be split to each investor. Each investor will get $20,000 of depreciation in the first year. Doesn't sound like a lot, but then when you add leverage, you add financing to the equation, you're able to take the depreciation based on the purchase price, not based on how much money you put in. So if you only put in 20% down payments, let's say you take 80% That's a little bit risky, but let's just, for our illustration purposes, be able to do that. You can now take, you put in $200,000 equity into the property. Okay, so again, we had 10 investors,
Right.
and every investor put in only $20,000. And we're getting to $200,000 equity. We're able to buy this $1 million property. Now, with the bonus depreciation, you'll be able to get the $200,000 of depreciation, and therefore every investor is going to get $20,000, which equals the entire amount that they invested. And
Wow.
so, multiply this by however much the property is worth, and the same equation applies. And this is how oftentimes you can have, investing in a property and actually getting back depreciation based on how much you actually put in.
That's a great point. That was one of my questions I had is we get depreciation on leverage as well, not just, so the bank's money too, not just our investment that we
Exactly.
put in the property. So in that case, if we get more in return because we are getting depreciation on the bank's amount too, if everybody's invested only $20,000 and they got $30,000 in depreciation that year, can they carry it over? And does it apply to, can you please talk about the types of income as well?
Yeah, exactly. So this is a really, really important topic to understand when you're an LP. You hear this, wow, these great tax deductions, great tax benefit when it comes to investing in real estate, but how much so? And that's something that's a little bit, confusing, and a lot of people have different opinions, well, not opinions, but maybe giving some misinformation. I don't want to use that word, but not giving the full picture. And so, just like you said, Deepa, that certain incomes are taxed differently. So the way that your W-2 or your 1099, whatever your active income, that's going to be taxed. That's considered an active income, Schedule C, okay, in your tax return. Passive income, rental income, or real estate investment income, that's going to be taxed differently, let's say in a different bucket of income. That's called Schedule E on your tax return. And so they're taxed differently, and the depreciation deduction is only going to be used against your Schedule E, against your rental or your investment income. And so this is something really important to note. There are exceptions to that rule, but generally speaking, that's where the depreciation will help you. Now, not to say that you're not going to get anything, you're not going to get benefit from it. There's certainly benefit, because think about, is there any other investment vehicle that that you may be able to take, get returns on your investment and also not pay any taxes on those investments during the years of ownership? So essentially, that's what cost segregation is going to do for you. And as you asked earlier, if you do have more deductions than income, then those extra losses, as it's called, those extra deductions will carry forward to next year. So you don't lose them out if you can't take them. So it's going to benefit you both on the income that you make and also potentially on the sale, because having extra losses carrying forward will actually help you, because those losses, if you have an extra kind of bank account of losses, they can be used to offset the gains that you'll have, whether the capital gains or what's called depreciation recapture, passive gains on the sale of the property, so you can benefit on both ends.
Right. And if the limited partners don't want to hold on to those passive losses until the sale, because sometimes it can take 5 to 7 years, they can use it on other syndications too, in which they have invested.
Correct, exactly. So like I said, any passive income or rental income, that's all going to be lumped together in one bucket. So if you have one investment, that's that. If you have 20 investments, all that income is going to be lumped together, as well as the the losses. So meaning, if you have extra losses, or you have, let's say, one investment exits and sells, and you're going to have a gain. Well, if you have losses from another investment or another property, you can use that to offset those gains. So that's how depreciation works as a tax vehicle, really a strategy to be able to use to offset other gains. So all within the realm of the investments itself.
Right. Thank you. So could you talk a little bit about bonus depreciation, because this is the last year to take 100% bonus depreciation, and it's been a big deal in real estate circles. So
yeah.
Could you please elaborate on that?
Absolutely. So this thing called bonus depreciation. So once you've done a cost segregation study, and what happens when we do a full cost segregation study, without getting into the nitty-gritty of the details, we're going to allocate different components of the property to faster depreciation schedules. either a 5-year or a 15-year schedule, and those things can depreciate faster. Once we've done that, we have the option to either take those deductions over those relatively faster schedules, right? Or you can take a lump sum of those accelerated deductions in the first year. And that's called bonus depreciation. So we're able to take right now, this came to being in the current form during the Tax Cuts and Jobs Act back in 2017. And so every year since, we're able to use this 100% bonus depreciation option, which, like I mentioned before, are taking that lump sum, a huge amount of deductions. However, this year, 2022, as was written in the books when the law was passed back in 2017, this year, 2022, is the last year we're going to be able to claim that 100% bonus depreciation. Next year and coming years, it's going to start to phase out by 20% each year. So next year, 2023, if you buy a property, you're only going to be able to take 80% of those bonus depreciation, of those accelerated deductions in the first year. Obviously, it's still going to be a lot. It's still going to be beneficial. And the remaining 20%, you can still carry over those faster schedules, those 5 and 15-year schedules.
Got it. Thank you. But it's going to get phased out slowly.
It's going to start phasing out.
20%
exactly.
every year. Got it. Okay,
Yeah.
Thank you. And recapture is this mysterious thing that a lot of people ask me about. So could you please elaborate a little bit on that, on recapture of these cost depreciation?
Yeah, sure. So there's something called depreciation recapture tax. And it's oftentimes misunderstood to mean like recapture, like I have to give it all back. And in fact, I've seen people say that in public forums. If you take depreciation, you just have to pay it back. But that's certainly not the case, and that's actually not true at all. However, this recapture tax is a tax that you are subject to on the sale of any property, any investment. And how that works, it's considered a capital gain. It's like an unrealized gain, because since you've taken these deductions during life of ownership, the IRS says, well, now we're going to tax you on the sale because you've exited that property, you've benefited from it, now we're going to tax you on that amount. And so how that works is it's actually taxed on 3 different levels. One level is the capital gain tax, max at 25%. Another level is going to be max at whatever your income tax rate is. And then a third level is a combination of the two. And so it's a little complicated, but in the end of the day, what it happens is, as I mentioned, when you sell a property and you have a gain, we know we're going to have a capital gain tax based on that. If you have this taken depreciation, you're going to have that recapture tax. Again, it's going to be less than whatever your income tax had you not taken those deductions anyways. So that's, first of all, it's going to be less. And second of all, since it's considered a passive gain, if your investment strategy is done right, you can actually have passive losses from depreciation from another property you've bought in the coming year, in that year of the sale, and use those losses to offset that gain. So essentially, you can actually cancel these out. There's other strategies like a 1031 exchange, which is a little less common in syndications, but it still can be done. And that will defer that tax, just like it defers the capital gain tax, will defer that recapture tax as well. So again, it doesn't mean you're going to pay it back, but does mean that you're going to have a lump sum, which is part of the reason why if a person is doing cost segregation and only planning on holding a property for a very short amount of time, let's say a year or two, it may not be as advantageous to do the cost segregation, because yes, you're going to get this lump sum of deductions right now, but you're not going to benefit from it as much because you're going to be subject to that tax on the sale, soon after.
Okay, so it's more useful to have a cost segregation study done on a longer hold and high value properties, because it's going to be a bigger deduction.
Exactly. Yeah. Higher value properties, longer holds, and really more than anything else, as an investment strategy overall. And what I mean by that is not kind of looking in a vacuum on one property, but kind of looking, okay, am I planning to invest in at least one other property or other investment every single year, for the next foreseeable future? And therefore, I'll be able to kind of use the losses from one to offset the gains from the other and keep it going.
Wow, so it can reduce the tax burden a lot if we plan in advance. And if there is a sale coming up, you might want to think about investing in a property to gain the depreciation this year, to offset that gain that you're going to get from an exit. So,
Yes.
and that's how all the real estate moguls and everybody does not pay that make 7, 8 digit income don't pay any taxes for their holdings and their gains.
Yep.
Okay, so that's great. So Yona, thank you so much. I really appreciate your time. And what's the best way for people to get a hold of you?
Best way you can find me is on LinkedIn. Believe it or not, I'm very active on that platform, and I would love if you would reach out to me on there and just mention to me that you listen to this. You can also go to yonaweiss.com.